So another important issue in our economy right now is what should we do with taxes? Should we increase taxes on the wealthy? Should we decrease them? What should we do about the middle class and the poor? Should we increase taxes on them, lower taxes, or is everything just fine as it is right now? So before we even talk about taxes and what we should do with our current tax system, we need to look at the Laffer Curve. So the Laffer Curve is basically an economic theory generated by Arthur Laffer in the 1970s, right? So he basically said that tax revenues, the relationship between the tax rate and the tax revenue exists if you graph it as a bell-shaped curve. So I'll explain what that means. So 0% tax rate, you would be expected to collect a 0% tax revenue. So $0 in tax revenue. Why? Because if you don't tax anybody something, you're not going to get any tax revenue. But the opposite is also true. If you tax somebody 100%, then you're not going to get any tax revenue either. Because if you tax somebody 100% of their earnings, they're simply not going to work. So the revenue maximization should exist somewhere between 0 and 100%. The question is, what is that point? So economists, when Arthur Laffer published his theory, they thought that this revenue maximizing point would be somewhere between 50 to 100%, so around 70%. But the Romer and Romer study, which was published in the National Bureau of Economic Research by Christina Romer and her husband David Romer, they actually found that the revenue maximizing point was 33% for income taxes. So what does that mean for us as a society right now? Well, it means is that we're doing it all wrong. The top income tax rate right now in the United States is 35%. So we're actually collecting less revenue. If we decrease taxes to 33%, not only would we get more growth, but we would get more revenue. And it also serves to show that politicians like Bernie Sanders are really working against themselves when it comes to taxes because they want more tax revenue to pay for things like free college, free healthcare, other free stuff, entitlement programs, expansions in the entitlement programs, but they're actually working against themselves because in an interview, Bernie Sanders said he was open to an idea of raising the top 1%'s taxes to 90%. But as we can see on the Laffer curve, this would dramatically lower the tax revenue. So is the revenue maximization point the best point to order our taxes? Should the top 1% pay a top percent of 33%? No. And the reason why is that tax revenues do not lower deficit spending. So a $1 in tax revenue, that $1 leads to a 12-cent increase in the deficit. Why? Because politicians aren't benevolent people. They don't look at a dollar in tax revenue and say, you know what, I will use that dollar to lower the deficit. No, they say, okay, that's another dollar in tax revenue. Let me increase my spending because I have more money to work with. So the idea that tax revenue, if you maximize it, that you could lower the deficit, it's simply not true because politicians don't work like that. So what should our tax rates be? Well, the growth maximization point is correlated to GDP growth. So as we can see at this growth maximization point, we will see the most increase in GDP values. So why is GDP important? So GDP is tied to our standard of living as a society. So the more GDP we have, the better standard of living we have. That's why countries in Europe or the United States, we would rather live in those countries than countries that have very, very low GDP values like Africa, countries like Ethiopia, South Africa, those kind of countries. We would rather live in the United States or Europe where there's a huge standard of living. The middle class can buy a flat screen TV, they can buy a car, they can have refrigeration, they can have AC, and it doesn't require as much money as it would, as much wealth as in the countries in Africa, like in Ethiopia, where those are scarce resources. So really, what we should do as a society is prioritize GDP growth, because the more GDP growth we have as a society, the better standard of living everyone in our society has, not just the wealthy, but also the poor and the middle class. And the growth maximizing point in the Romer and Romer study was actually 10%. And as we can see on this graph, the change between the revenue and maximization point and the growth maximization point, 10%, 33% is a 23% difference. Obviously, it wouldn't be politically expedient to lower tax rates, the top income tax rate from 35% to 10%, but somewhere in the middle, that would generate huge amounts of GDP growth. Now, you might say to me, well, this is just a theory. The Laffer Curve is just a theory. It was instituted in the 1970s. That doesn't make any sense. 70% tax rate, I should get more at a 70% tax rate than a 33% tax rate. So there's actually an article by the Heritage Foundation. It's called The Historical Lessons of Lower Tax Rates. You can check this one out. So in the 1920s, which was basically the birth of trickle-down economics, we all think it's the 1980s, but it actually is the 1920s. So Secretary Andrew Mellon, he actually lowered tax rates hugely. So the tax rates in the 1910s during the World War I, it was actually extremely high because Woodrow Wilson, he actually instituted the progressive income tax, and he made the top 1% pay a lot to fund the war. So after the war in the 1920s under Calvin Coolidge, Secretary Andrew Mellon, he lowered this tax rate by a great margin because we were now out of the war. So we would think that because he lowered the tax rate of the rich, the tax burden of the rich would also decrease, but it actually the opposite happened. So tax rates climbed from 44.2% to 78.4% by the end of the 1920s, and it effectively almost doubled. And this can be explained in other decades as well, like the Kennedy tax cuts and the Reagan tax cuts. So this idea that the higher the tax rate, the higher the tax revenue, well, that's just simply not true. Another tax rate we should also look at is the corporate tax rate, and the Laffer Curve also applies to the corporate tax rates. So as we can see, the corporate tax rates from the 1960s to the mid-1980s, that was increasing slightly. And tax revenues, they were also increasing slightly as well. But then we see this huge dip in tax rates for the corporations, and it's been followed since 2010. And we see this huge spike in GDP, in corporate tax revenues. So this huge spike can be explained by the Laffer Curve in action. The less tax rates, the more competition, the more growth, and then you get to tax that growth. Now, you might say, well, what about this point on the graph? Well, this can be explained by the 2008 recession. Of course, during the 2008 recession, it would make sense for corporate tax revenues to fall because a lot of businesses went out of business. A lot of Wall Street businesses lost their stock, so it makes sense. So this point of the graph where this huge dip in the tax revenues, that shouldn't be, viewed. The next thing we should look at is what is the share of federal income taxes in the United States. So whenever you listen to politicians like Bernie Sanders, they're always like, the top 20% or the top 1% in this country needs to pay their fair share. And you always listen to this and you're like, wow, I can't believe that I'm paying less in taxes than, I'm paying more in taxes than the 1%. Like, that doesn't make any sense. I'm a middle class person, I'm a poor person, it doesn't make any sense. But as we can see, the top 20% in our country pay nearly 95% of the federal income taxes in our country. And if you look at the top 1%, and the top 1% is an extremely small subgroup in the top 20%, they pay nearly 40% of that 95% in federal income taxes. And if you look at the middle class, if you do the numbers on this, the middle class is paying 4% in federal income taxes, and the poor are paying a measly 1%. So this idea that the rich aren't paying their fair share, it's completely absurd. They're paying more than their fair share. You would think that a fair share means 50% or even lower because they're such a small subgroup of our society, but no, it's nearly 95%. And if you look at deficit spending, you might say, well, this is the price we have to pay. We need to tax the rich a lot because if we don't, then the deficit and the debt will increase. But taxation is a very small part of deficit reduction or increases. The real increase in deficits happens when our spending increases. Because as we've seen, tax rates don't really matter that much because, of course, if you lower tax rates, then the deficit will increase because we have less revenue. But if we increase tax revenues, then the deficit will still increase because for every dollar collected in tax revenues, there's a 12% increase in the deficit. So this idea that, taxes drive the deficit, it's simply not true. Spending drives the deficit. As we can see, major health programs, Social Security, entitlement programs, those are the burden of our society in terms of percent of GDP. Those are the programs that are increasing our federal spending. And if we institute things like free college, free healthcare, and other sorts of entitlement programs, then this explosion in the federal spending will increase our deficit, no doubt. So another form of taxation that I want to look at is the federal estate tax. And the federal estate tax is basically called the death tax. It's a tax on somebody dying. A rich family, one of their members die, you tax their wealth nearly 40%. Before I talk about the economic implications, we should look at the moral implications. So imagine the loss of a family member. It's extremely troubling. It's extremely sad. You've just lost a family member. Now couple onto that a 40% tax on that person's wealth. It makes no moral sense at all that you would pile on the hurt that that family is having by stealing nearly 40% of the man or woman's wealth who had just died. But of course, if you're a leftist or a liberal, you're not really going to care about these moral implications because you think that if we take 40% of their wealth, we can help the poor or the middle class out, and it'll actually create more good for our society. But it's actually not true at all. The Heritage Foundation, they did a great research paper on this, and they found that eliminating the federal estate tax would boost the U.S. economy by nearly $46 billion over the next 10 years and generate an average of 18,000 private sector jobs annually, and that means per year. So who is benefiting from this job creation? It's not the rich, it's the middle class and the poor who are getting these jobs. So 18,000 jobs are created annually for these individuals. So we see that eliminating the federal death tax wouldn't hurt the poor, it would actually help the poor. So you might say to yourself, well, that's all fine and dandy, but what do we have to do as a society? What should we do? And there's been a lot of talk on the left and the right how we should order our tax system. The left obviously favors the progressive tax system as we have right now, but a little bit more emphasis on the divide. So the top 1% would pay substantially more than the middle class, and the middle class would pay substantially more than the poor. So it would be a more divided progressive tax. And people on the right, they favor a flat tax or a progressive consumption tax. And a progressive consumption tax is basically a sales tax in lieu of a income tax. So you basically pay a 25% sales tax, but you'd have no income tax. But I think that the most politically expedient thing to do is just reorder the system we have right now. So if you didn't know, we have a progressive tax rate. And that basically means that the more you make, the higher percent of your earnings will go towards the federal government. As we can see, people who make $33,000 to $82,000 a year, they have to pay 25% of their income to the federal government. And if you make over $300,000, you have to pay 35% of your income. And this should be reordered so that the growth maximization should be instituted, right? Not the revenue maximization. So what I'm saying is that the top tax rate should be around 10%, right? Because this 10% would increase growth magnificently, right? Because the 10% point on the graph is actually the point where the most revenue, not the most revenue, the most growth is instituted. So we would see extreme amounts of growth, and of course GDP values help us all in society. So the lowest tax rate should be 0%, the highest tax rate should be 10%. This would, of course, lower tax revenues beyond, the 33% because you're lowering it past 33%. But the simple fact that spending drives the deficit, not tax revenues, is extremely important for you to understand. So I hope that you've learned something about taxes today. The Laffer Curve, how that works in our tax system, how it has been historically proven, corporate tax rates, the share of federal income taxes, that the rich is really paying a lot more than people like Bernie Sanders would like you to think, and that it's not the taxes that are driving the deficit, it's the spending. And I hope that you've learned a lot about the moral implications and the evilness of programs like the federal estate tax program. So thank you and have a nice day.